Inflation is an economic phenomenon characterized by a general increase in the prices of goods and services over time, leading to a decrease in the purchasing power of money. Inflation is not a popular term among the population because it basically means you can buy less things with the same amount of money. And there is a good reason for that. The hyperinflation in Weimar Germany, Zimbabwe, Venezuela, and Argentina led to disastrous outcomes and threw the majority of the population into poverty. However, if we exclude these extreme events, moderate inflation is actually what policymakers strive to achieve. Why would the politicians want the price of everyday goods to go up, not down? Have you ever wondered why? Firstly, inflation encourages consumer spending. When prices are expected to rise, consumers are more likely to purchase goods and services sooner rather than later to avoid paying higher prices in the future. Imagine that you want to buy a Tesla car. If the price of a Model 3 car increases 2% every year, your logical decision will be to buy the vehicle now to avoid paying the higher price in the future. This increase in demand can boost economic activity. For example, during periods of moderate inflation, households may accelerate their purchases of durable goods like cars and appliances, contributing to economic growth. Secondly, inflation stimulates investment. Businesses are more likely to invest in new projects and expansion when they anticipate that the prices of their products will rise. This expectation of higher future prices can lead to increased capital expenditures. For instance, during the late 20th century, moderate inflation rates in the United States were associated with robust business investments, which helped drive economic growth and innovation. For example, the 1990s saw a significant rise in business investments in the technology sector, particularly in software and internet-based companies. Companies like Microsoft, Apple, and many emerging internet startups received substantial investments, which fueled technological advancements and the growth of the digital economy. Lastly, inflation facilitates employment. In a company, nominal wage cuts are rare due to worker resistance. This is often why companies are forced to lay off employees rather than cut wages when the company is in a bad situation. However, with moderate inflation, real wages can decrease without reducing nominal wages, helping to maintain or even increase employment levels. Studies have shown that inflation rates around 2 to 3% can help grease the wheels of the labor market, making it easier for employers to adjust wages in response to economic conditions. The trade-off between inflation and unemployment is illustrated by the Phillips curve, showing an inverse relationship between the two. According to this theory, periods of low unemployment were associated with higher inflation. There are cases where high unemployment rates come with high inflation, making this theory less applicable. This is called stagflation and was witnessed during the financial crisis of 2008. However, the Phillips curve still generally holds true. Another reason policymakers try to aim for moderate inflation is due to the fact that they want to avoid deflation at all costs. Yes, cheaper prices are good, but the damage can be long-lasting. When we go into a deflationary economy, we would go through everything opposite of what would happen in an inflationary economy. Decrease in consumer spending, investments, wages, and higher unemployment. But the real problem is the difficulty in controlling it. Central banks typically use monetary policy tools, such as interest rate adjustments, to stabilize the economy. When the economy is overheating and inflation is rising too quickly, central banks raise interest rates to cool down spending and borrowing. Higher rates increase the cost of loans and capital, which can slow down economic activity and help control inflation. When the economy is sluggish or in a recession, central banks lower interest rates to encourage borrowing and spending by consumers and businesses. Lower rates reduce the cost of loans, making it cheaper to finance investments and purchases. This is what the Federal Reserve has been doing all this time. During the pandemic, the Federal Reserve quickly lowered its benchmark interest rate to near zero to prevent the economy from crashing. After the pandemic, they raised the rate to 5% to combat inflation. During the oil crisis in the 1970s, the Fed even raised the rate to 20% to curb inflation caused by skyrocketing oil prices. However, deflation can render these tools ineffective because interest rates cannot normally fall below zero, limiting the central bank's ability to stimulate the economy. After the Japanese bubble burst in the 1990s, the Bank of Japan embarked on a policy of quantitative easing, increasing the money supply and lowering long-term interest rates down to near zero. Despite these efforts, deflation persisted. Consumers and businesses, expecting prices to fall further, continued to delay spending and investment, perpetuating the cycle. The Bank of Japan was forced to introduce negative interest rates in 2016, effectively charging banks for holding excess reserves in a bid to encourage lending. It took almost 3 decades for the Japanese economy to finally escape its deflationary cycle. This is why central banks, like the Federal Reserve, aim to maintain a low and stable inflation rate in the first place, typically around 2% per year, to ensure economic stability and growth.